It's not a wind up. Every single time I try and film, the baby cries, and so I have to just hold her to stop that happening. Welcome to my video. I'm Shady Josh on Twitter, and I've recently started a new Lemonade channel called Lemonade to the Moon. So I want to talk about something big today. I want to talk about what I think could be a poker move by Lemonade management. A quick disclaimer. I do work in the insurance industry, but all of the information that I've used in this video is publicly available, and nothing on my channel will ever be investment advice. And I want to encourage everyone viewing to do your own research into Lemonade, the company, and the opportunity. Thanks for watching, and I'll see you at the end of this video.
In the past year alone, we've doubled our pet business. And we just announced a strategic partnership with Chewy, offering Lemonade pet insurance to its 20 million online customers who are already used to buying pet insurance online.
So as Maya just explained in that clip, the pet market is growing very, very quickly. The size of the market at the moment is quite small, but it's growing extremely fast, around 25% per year. This graph shows the premium growth from 2016 to 2020, up from $800 million to $2 billion. And then more recently, we've seen even more growth up to 2023. This is the premiums in the market. So again, growing over time, and very healthy rate increases have also gone through in the last 3 years. This slide shows the premiums up to the year 2020, but know that in recent times, again, see my other presentation, Lemonade and other competitors have put through some very significant rate increases. This slide is really, really important. So this is from Trupanion, who I believe is Lemonade's key competitor in this space. And it shows that at the time this was made, there was about 1% penetration in the US market. And what that means is that of all the households in the US that own pets, it's about 87 million right now. Only about, well, currently about 2.5% of those have insurance. This slide is a little bit out of date. That's just a really, really low number. Compare the US number to the UK number. So in the UK, where I live, about 25% of households who have pets have insurance for those pets. So the growth opportunity is stunning, because if the US and Canada, or just the US for right now, if the US grows market penetration over time so that more and more people buy pet insurance for their pets, that market just has so much room for Lemonade and for other players to compete and to grow and make a lot of money. So here's a graph of Trupanion's earnings, and I suspect that you can kind of guess where I'm going with this presentation. Trupanion has grown exponentially, as you can see on screen. These are the Q3 23 numbers, and it shows that for a very, very low base in 2010, 11, 12, 13, the company has just compounded and grown very, very stunningly well over time. And up and to the right is always a graph that you want to see if you're an investor. And it makes us think, well, should we just buy Trupanion stock? I mean, maybe that might be a good response, but I think there's more to it. So let's press on. We'll look at this slide for a second. So this is the average premium by state, and it just shows that Lemonade is massively undercutting Trupanion. I suspect that Trupanion at the moment has quite a good brand strength, because they've just been in the business for a little bit longer. But Lemonade is kicking ass here. Like, average premiums of $500, and they're still achieving a 77% gross loss ratio as of Q3 23, versus Trupanion with I think it's like $850 average premium per policy. It's almost half, and yet Lemonade is succeeding in profitability. So really, really good to see, and it just shows how much space there is for Lemonade to grow. In my other video, I talked about the rate increases that both have put through, and it was around 15% for Lemonade in the last few months. And this is Trupanion's rate increases by state. again, some quite significant numbers here. So Trupanion is not taking their foot off the gas in terms of raising rates and pushing through price increases to customers. They are on the gas, and we saw from the chart just now that their growth is accelerating over time. So looking like a really healthy business for Trupanion. So here are some stats for Trupanion as of Q3 23. Trupanion revenue is 100% pet. So pet is the only product that the company sells, and that revenue was 285 million per quarter, or in Q3 23. But if we just annualize, that's over $1 billion a year. They don't give the number of customers. To be honest, their numbers are a bit strange. They don't give there's a lot of metrics I would expect to see that they don't give, but for example, they don't give number of customers, but they do give number of insured pets. So fine, maybe that's just the way they want to do things. The operating loss for Q3 23 was close to zero, negative 3.5 million. But if we strip out the cost of acquiring new customers, which would of course accrue into future earnings, and also we strip out stock-based compensation, the figure is actually like 19 million positive. And then there's other things that we could also strip out, like depreciation, amortization. I haven't done that here. The company has cash of $266 million, and long-term debt is 128 million. So net cash of about 130 million. And very interestingly, for a company that is just about free cash flow positive, the market cap is only $1.2 billion, $1.15 billion. And I find that pretty interesting that, it looks like a pretty good company. It's got very good growth. There is, pretty good balance sheet there. There's, quite a long history of brand loyalty and so on. Looks pretty cheap at $1.2 billion. So the big question is, and I guess that you have foreseen that I'm going to ask this question, is what if Lemonade bought Trupanion? This just occurred to me when I was researching for my pet video. I thought, man, this looks like something that it's worth looking into for sure. Let's just talk about some numbers, right? So if we ignore reinsurance for a minute, and the reason for that is that Trupanion does not have reinsurance. So ignoring that, let's just say for right now that Lemonade retains all of the premium themselves. They don't cede any to reinsurance partners. We know that they have about 200,000 pet customers right now, and the average premium per customer is around $500. And so that is a revenue number, or a annual premium number of $100 million. But Trupanion has a Q3 revenue of 285 million. And so annualized, that is $1.15 billion. So if we take a simple approach, and I know this may not be strictly accurate, but it's just a simple analysis, a simple example. Let's just say that premium equals revenue. And so the combined proxy in-force premium for pet, for Lemonade plus Trupanion combined would be around, let's say, $1.25 billion. And then let's just assume a combined loss ratio of 75%. Again, Trupanion don't make it easy to look at their financials. They kind of mix a lot of things in. They don't give a clear loss ratio like Lemonade does. Actually, I find the Lemonade financials quite transparent. I find them easy to understand, easy to look at. Reading Trupanion's financial reports was just not nearly as fun, and it was a bit more difficult to see where all of the numbers were. But let's just say a 75% loss ratio, which is the Lemonade number. And let's go with expenses of 15%. Again, this might be a little bit ambitious in the short term because there would be some integration expenses, and there would be some stuff to clean out and to take care of. So the costs in the short term might be a bit better, but let's just see past that and say in the long term, 15%. So the proxy profits in this case would just come through to about 10% profit margin, so 125 million per year. So yeah, okay, that's okay, but we'll see later on in the longer term it kind of becomes a more compelling story. Now it's worth noting that Trupanion does not have any reinsurance, and this is very important for this story and for this presentation. And we'll come back to that. So how is it possible? We know Lemonade has got about 945 million of cash as of Q3 23, so that is quite a bit of cash, but it's not enough to buy Trupanion, which has a market cap of $1.2 billion. A lot of that cash will be needed for the runway because the other products will need some cash as a buffer before they switch to profitability. It will take some time to get to scale, so a lot of that cash will be needed. So that's not really a great option. But there are other options, right? So number one, there is a institution called General Catalyst, and they have been kind of working with Lemonade for the last like 6 or so months and financing the cost of acquiring customers. So the initial deal was for, I think it was for 150 million, and then recently in the last week it's been announced that there's another 140 million, so total 290 million of funding has been pledged, and the company will be repaid for the net present value of future cash flows arising from policies sold. So for example, for pet, they'll finance the acquisition of customers, and then when those customers join Lemonade and start paying premiums and so on, of course, claims will be paid out over time as well, but after taking the kind of positive cash flows, that will go back to General Catalyst. So it's possible that a company like General Catalyst might be willing to finance this acquisition. Like maybe Lemonade could get a private equity partner, but I'm not sure about that. That seems a bit unlikely. So option two would be, of course, if a lot of guys are saying Lemonade is the stock is going to increase a lot in the next couple of years. Not financial advice, so I won't comment on that. But if that was to happen, then of course Lemonade could issue stock on the market and raise some capital and then use that to fund a takeover. But again, that in the short term, that seems unlikely. Given the current market cap, and also bear in mind in a market where Lemonade goes up a lot, it's quite likely that another small insurtech company would also go up quite a lot. So the opportunity might be difficult. But there's a third option, and this is the one that I'm going to focus on. But before we get into what that third option is, I want to ask you a question. Who are these two guys? I need to just grab my notes. Okay, so the guy on the left is called, he's called Jean-Jacques Henchos. He's 60 years old and he's employed at a large business, and his compensation is about $3 million per year. And the guy on the right is called Christian Moment-Taylor, and he's 51 years old, and his salary is about $8 million per year. So he seems to be doing better than the other guy. Now these guys both have some things in common. They both work for a similar type of organization, and they both have a problem. Not so much a problem, but something that they want to do well at. So every quarter, both of these guys, they go on a big phone call, and a lot of people called stock analysts ask them, where's the growth coming from? When is your company going to grow? When are we going to see increases coming through? And of course, these are insurance executives. Notably, they're actually reinsurance executives. And so the guy on the left is the CEO of Hanover Re, who's a big reinsurance company, and the guy on the right is the chief executive of Swiss Re. So both of these guys are under pressure from the institutional investors that they kind of answer to show growth over time. So if we go to the next slide, this is the Swiss Re revenue growth, and I could only find a picture up to 2021, but you get the idea. realistically speaking, since from 2013 to 2021, the growth was marginal. Slight increase, maybe it's like 82 up to 95, but over like 8 years, that's pretty weak. So this kind of emphasizes for the chief executive of Swiss Re, like if you have this graph, what do you do about it? If you've got institutional investors asking you, like, when are you going to show growth? What do you do? So if we go to the next slide, what if you see this? What if you are browsing the internet late at night and you're just randomly looking at YouTube channels and you stumble upon this graph and you say, what is this? I like the look of this. And you find out that it's in the pet market in the US and it's a company called Trupanion. And you think, man, that's good. I think I need a piece of this because this would come through to my revenue and then I could show this to my institutional investors. And then you find out that Trupanion does not have any reinsurance. They are not interested in sharing all of this good revenue growth with the reinsurance market because they just want to keep it for themselves. So that's pretty upsetting for you. But I guess on the plus side, you can work with Lemonade, who is willing to share the premiums and the profits and so on. So that's one thing. But you think, man, I really could do with having a piece of this pie.
We do have very good relationships with our reinsurance partners, and they are the largest, biggest, and most highly regarded reinsurance players in the world. So folks like Hannover Re, who are really our anchor reinsurance partner for many years now, Swiss Re, these are two of the three largest reinsurance companies in the world. And yes, they, having spent a lot of time in Hanover with the leadership there, they are entirely bought in and they are putting their money where their mouth is. They are riding this alongside us. So I think the short answer is yes, they see things very much in line with how we see things.
Mm. And I think that sort of speaks to the fact that you guys, within this hard reinsurance market, were still able to get very similar terms, although you did make some exclusions. Is that also a fair statement?
Yes. The world of reinsurance, at least with some of the players, is still very much reliant on long-term relationships. There are some reinsurers who are considered to be much more transactional, but the people that we work with are much more relationship and long-term in their nature. And therefore, even as reinsurance markets harden, we've been able to secure terms that, had we just walked in off the street, would not have been, if it had been more of an arm's length deal in the sense of not out of context of a long multi-year partnership, would have been much harder to secure.
So luckily for the chief executives of Hannover Re and Swiss Re, they already have a really great relationship with a key partner who might offer a solution to the need that they have for growth. And Lemonade has a really great relationship with Swiss Re and Hannover Re and other reinsurance partners who have much deeper pockets and more expertise. No offense to Lemonade, but reinsurance guys will have more expertise in many cases. It could be a win-win for both sides. The relationship's there, and this is a possibility of a deal that the two sides could work on together that would meet both sides' needs, right? Both the reinsurance partners and Lemonade will want Lemonade to grow the pet portfolio and, of course, the rest of Lemonade's business over time, and to kind of reach scale, to reach profitability, so that they can both write increasing amounts of business for decades into the future. The reinsurance guys will want Lemonade to succeed, and so if Lemonade could present a case to them to kind of put a deal together, and they could demonstrate from data and the analysis and so on that the profitability that would come through, I think it kind of makes sense for both sides. And I think financing wouldn't be that difficult in the context of the opportunity if you put a really good model together and really looked at the implications in the operating leverage, the scale. Kind of putting two companies together quite often results in some really good synergies. So there will be some tech that Trupanion has that Lemonade doesn't have, for example, being embedded in the network of vets and the brand and just the customers as well. Like, remember that right now, Lemonade has to pay to acquire customers. So for every single pet customer, they have to pay for like marketing and put on marketing campaigns and work with General Catalyst, then it's a lot of money to acquire customers. It's not free, right? But in one fell sweep, Lemonade could like acquire, let's call it 1 million customers in one go for $1.2 billion. Doesn't seem like that bad a deal to me. So coming down, then we come to option 3. So the reinsurance partners fund the takeover of Trupanion by Lemonade. Again, just to re-emphasize, the majority of Western insurance markets are mature and they're slow growth, right? Everybody, for example, in the UK, everybody who is going to buy home insurance has home insurance because you have to buy it by law. And I imagine it's the same in other Western countries. Again, motor insurance. If you have a car, you already have car insurance because you have to buy it. But as we saw earlier in the presentation, a lot of guys with pets don't have insurance. And so that is a huge opportunity. As that market matures and develops, the market will grow by logic, it has to. And Lemonade has an opportunity to take a huge slice of that if they can play their cards well. Reinsurance guys need to be able to show premium growth to investors. You can't just show up every year to board meetings and show the exact same revenue number that you had last year. It's not going to work. You'll get voted out of your position of power, and nobody wants that to happen. So there is an incentive there for the reinsurance guys to go out and find some growth. Trupanion is not sharing the love. They have ignored the reinsurance market. I did some, I looked at some of the annual reports, and there was some quite strange wording. Like some of the things that were said, I found a little bit confusing, or not confusing, just a little bit. Things were a bit off. They were like, we want to hold on to all this profit for ourselves, and it's not a long-term great idea. I think Lemonade has been very, very smart in the ways that they have built those relationships with ultimately quite powerful people and well-funded people. Those reinsurance guys have a lot of money, they have a lot of expertise, and they have a lot of influence in high places, to be honest. So funding Lemonade to buy Trupanion would give those reinsurance access to growth. So how could it work? So obviously the money has to come from somewhere. I guess that, let's say, a majority came from reinsurance partners. Maybe General Catalyst would get involved somehow, or other private equity partners. And maybe Lemonade would put in some of the cash that was needed. So it could be kind of a joint venture between like Lemonade and others. And I believe that Lemonade would have to give some of the equity in the new enlarged company to those reinsurance partners and other equity partners. And again, that's not a new thing. We know that Lemonade has at the moment established a partnership with Chewy, and that's a distribution play. So that's on one end. You've got distribution agreement with Chewy, and then you could have a reinsurance agreement with these reinsurance partners. Again, giving away equity is not new to the company. It's something that's already in place with Chewy. And so if Lemonade were to give some of the equity to the bigger company to those reinsurance partners, then that would, be an incentive for those reinsurance partners. But then in addition to that, Lemonade, as part of the deal, might say, look, we will give you, let's say, we'll cede 75% of premiums to you. And so instantly, the reinsurance guys, have an outlay today. Let's call it $1 billion. Although there'd be a premium to pay, of course, but let's just say $1.5 billion or something like that. But then day one, as soon as that deal closes, Lemonade would then be ceding back profit and premium to the reinsurer. So it's kind of a cash flow thing, and I think it kind of makes sense. I'm not going to get too deep into the modeling, but think about the concept. The Trupanion market cap is currently 1.2 billion, so that's not a huge amount of money. Interesting, actually, it's almost the exact same as the Lemonade market cap. So both companies have the same market cap right now. Go figure. And I think that post-integration, the profitability and the return on capital employed could be really good. Again, bear in mind that as the portfolio gets bigger and bigger, you get reducing capital requirements with respect to the premium because of the law of large numbers. And of course, you just get synergies anyway, right? So expenses of settling claims and like marketing efficiencies and all of those kind of back office things. There's typically quite good synergies and cost savings available when you merge two separate different companies together. Okay, so let's just have a bit of fun. Again, everything in this presentation is totally made up. I have no insight as to like whether this deal could work or what the numbers would be. But let's just go with some numbers, right? So we saw earlier that Lemonade has about 200,000 customers today. Trupanion has 1.7 million insured pets, and let's just say that that means like 1 million customers if we account for multi-pet households. And so, let's just say that's 1.2 million. And then over some period of time, let's say the new enlarged company could grow that up to like 2.5 million customers. We could go with, for sake of an example, premium per customer of $700, which is about average between the current Lemonade 500 and Trupanion $900 per customer. So with those calculations, premium would come in at about $1.75 billion. And then if we go with a 60% loss ratio, for sake of example, could be high, could be low, but it's the current predicted loss ratio for Lemonade. So there's some basis there. And then we assume 15% expenses. All of that comes through to a simplified profit of 440 million per year. And in this example, I've just ignored the implications of ceding underwriting profit to the reinsurers for Lemonade's figures. But on the flip side, there would be ceding commission coming back to Lemonade. So who knows how that would come out in the wash. So that's just a kind of very high level example. Of course, if this kind of takeover was to go through, the Lemonade team would do significant work to really work out what these figures are. We would never know what they were. We'll just find out afterwards. Okay, in summary, Lemonade has got a huge opportunity in pet, with or without a takeover of Trupanion. I think that pet is going to be an absolute winner for the future. Go and see my other video for more details on why I believe that's the case. But I think pet and renters will fund Lemonade, the company, for like decades to come. And ultimately, Lemonade will grow into big, scary classes of business like casualty and, big property classes and so on. But that's a long way in the future. The cash flow from pet and renters will fund all of the future products that we see in the future. If Lemonade was to buy Trupanion and those companies were to kind of merge resources and so on, I think that it would give Lemonade a huge moat. It would give them a really durable competitive advantage. And I think that Lemonade could pull this off. I really do. It seems a bit crazy to have a company with a $1.2 billion market cap buy another company with 1.2 billion market cap, but stranger things have happened in our world. So I'll wrap things up there. Again, nothing in this presentation is financial advice. All examples were made up and should not be used in any application. I've been a little bit liberal with just going for it and making this video, but do your own research into the company and the opportunity. And I hope to see you again in future. Thanks for watching. Please do like, share, subscribe, and I'll see you again in my next video very soon. Bye.